Worldwide markets this week. Emerging markets, 20 years of poor returns. Checkers Sixty60, almost a 20 billion rand revenue business. ASP Isotopes lists on the JSE ahead of Renogen takeover, but that pricing looks weird. Gold and silver running. August vehicle sales, another record month. I'm Simon Brown. This is Worldwide Markets episode 646 for the 3rd of September. I am recording this Tuesday lunchtime. Worldwide Markets, powered by Standard Bank Global Markets, Retail and Shyft, the global money app that puts travel, shopping, payments and investments in the palm of your hand. Enjoy the cheapest forex rates anytime, anywhere. Shyft, powered by Standard Bank. So let's kick off. First off, thanks to Standard Bank, thanks to Shyft, we appreciate that. But let's kick off on the emerging market story. So I was looking into a lot of the emerging market ETFs on the JSE. So they are rand denominated, and their returns have been so-so. So I went and looked at them in dollars. I thought, let's look at them in dollars, and that then gives us an ability to compare against other sort of emerging markets and get a real sense for what we're actually seeing. And I have to say, I was surprised by what I saw. So what we've essentially got is, let's start right at the top. We're looking at 20 years. This is return. This excludes any dividends. Top of pile is NASDAQ, 1,400% return. That's a 14.5% compound annual growth rate, CAGR. That is a big number. That is a massive number. Gold, which I threw in for fun, has given you 10.9% over that period, which equals almost 700%. And the S&P, little under 440%, which gives you a CAGR of around 8.75. That's a good number too. But then the emerging market. So the emerging market ETF, EEM is its code in New York. It has delivered 193%. That is not a particularly thrilling return at all. It is 5.5% compound annual growth rate. South Africa is sitting up there. What have we got? 5.6. The bottom of the pile is India, 3.8. We have got the Mexico, just over 6%. Brazil, just under 4.6%. China, large cap, 5.6%. The short answer is, remember 20 odd years ago when we were all excited about emerging markets and we thought this was going to be, the future of investing. That certainly felt like what it was going to be. And if you go back to the phrase BRIC, which was no S at the time, coined in 2001 by Goldman Sachs economist Jim O'Neill in a paper that he wrote, and he referred to BRIC, Brazil, Russia, India, and China, as the powerhouse for the global economy, but also equally the powerhouse for investors going forward. And it simply hasn't happened. It just hasn't happened. Look, the returns are poor. I mean, they're in dollars, 6% in dollars. You can add a couple of percentage points for the dividends, call it 8.5 for South Africa. And that's not the worst return in the world, but it's not the story that we expected. Now, we know the South African story. We know 15 years of almost no GDP growth, sort of belaboring along at 1%. But there's more to it. Firstly, this is an old story. The economy is not the market. So the economies might have done better, and in many cases certainly have. Brazil, India, China have all done significantly better, but the markets have not. Why haven't the markets? Financial crises have been significant setbacks. Currency depreciations have really hurt, and that has sort of really put a dent into those emerging companies. Particularly the inflation worries. Inflation starts to run and interest rates go up, makes borrowing more expensive, makes companies more cautious. Currency just makes it hard to respond, and perhaps less good responses in terms of QE and stimulus during the two big crises during that period, the 08-09 financial global crisis, and of course we also then had the pandemic in 2020. Poorer, lower levels of corporate governance. Maybe not so much locally. We've got fairly good corporate governance, although a bunch of you are saying, oi, what about Steinhoff? I mean, fair shout for that. But certainly in China, in Brazil, in India, lower levels of corporate governance, higher risks, therefore, bankruptcy, weaker financial systems, and that all limits access to capital. It also means that investors are a little more reticent to jump in and say, this looks like a good deal. They're just kind of like, not so sure. So emerging markets certainly have had their challenges. The flip side of the equation is that it really has been 2 decades of exceptionalism out of the US. The dot-com bubble burst, and then sort of be taking from August of 25 over the next 20 years. And what we saw was those big tech companies. Google listed in 2004. We've got Meta coming to market. Was it 2011 or 10? There's about and just these giants of tech. And of course, we can mention NVIDIA and the like. And that's kind of sucked all the air out of the room and sucked all the money into the American markets. The question then is, and I mentioned last week, that typically not typically, every time the S&P's been on a PE of around 23, the forward return of the next decade has been around 0. You get some dividends, but you don't get much else beyond that. The question is, if that is true, does money start now rushing into emerging markets? And I got to say, I'm not so convinced about that. I mean, bond markets are completely blowing out. I think money's rushing into perhaps a few places. And I think one of those few places is going to be Europe, although T's and C's apply. And of course, gold. I mean, we're absolutely seeing it in the gold space. And on that, let's have a look at gold, because gold is once again on the move. And gold has been, and I mentioned this a number of times, gold has kind of been stuck, for want of a phrase, ever since the pandemic, the Liberation Day tariffs, which back in April, gold jumped up. It was starting to move already. It was a little bit range bound, trading at sort of around the 2,900, 2,800, and then the Liberation Day tariffs arrived. Gold broke higher and then got into a new sort of range of around 32 to maybe 34.50, and now it's gone higher again. 3,484 gold futures, which is usually what I'm tracking, is trading at around $3,560 an ounce. And there are a couple of things why gold is absolutely running. The first is simply central bankers continue to buy. In fact, FundStat just came out. For the first time in 30 years, central banks hold more gold than they do US Treasuries. Now, there's 2 reasons for that. One is the massive move in the gold price, almost, sort of doubling since 2022. That obviously significantly helps just the value of the gold in there. But of course, we're seeing less buying of treasuries. I mean, that's absolutely it. And that is, the whole worry, and it's not just a US worry. We're seeing, I mentioned last week, the UK 30-year is back at 1998 levels. The US 10-year, it looks like it's sitting around 4.2, but if anything, I would call it closer to 5 quite easily. We've got Japanese 30-year at the highest it's ever been, like in the history of Japanese 30-year bonds. And that is around worries of stagflation. In other words, low interest rates, low growth, high inflation, worries around that, worries around debt to GDP and just debt generally, and how do they continue to spend when they've got so much debt and the debt bill just gets ever and ever larger. So there's a lot on the side of gold right now. There's also Jerome Powell's pivot back at Jackson Hole 10 days ago, where he essentially said, we're not going to worry about inflation so much, we're going to focus on jobs data. Now, we've got some jobs data later this week, but we had PCE, which is their preferred measure of inflation, 2.9%. That's a giant number, especially when your target is 2. He's saying, we'll let a little bit of inflation go, but it's transitory or not of a worry. And of course, if it isn't transitory, then it does become a worry. Then you've got high inflation, low rates, not much GDP growth coming through. You have stagflation. What do you do when there's stagflation? You buy gold. I mean, that's just the simple answer. You just buy gold when there is that sort of challenges. You buy gold and you keep it nice and simple. I want to look at silver, and I can never find silver, so I know I'm going to have to cheat it. Silver is not something I ever watch, literally never. But it was mentioned by Nick Kunza on my show on Monday morning that silver had breached the $40 level. which is fairly important. Silver's not at highs as we're seeing with gold. Silver is kind of back at the 2011-ish highs. I remember a client when I was at online share trading in '08 who got fanatically excited about silver when it got to 20 back in 2008, then collapsed to 10, got back to 20. Eventually, it got to sort of $50 in 2011. That's August 2011 when the US got downgraded. That's the all-time high. We haven't got past that yet. Why silver? I don't know why silver so thoroughly excites people, but the key lesson here is that commodities are tough. They're hard to trade. They're hard to manage. You might even get the story right, but the price might not necessarily follow. Why? Well, because when prices run, folks go and produce a whole lot more. That's just how commodities play out. So that's the nothing fancy about that. And when that happens, it does just mean that it is going to be tough for those prices to continue going, because high prices mean that folks are saying, lovely, like me a high price, but miners are saying, love that, but I'm going to go off and get myself more capacity. That is always hugely important. Two bits on the Just One Lap website. We had Keelan and Groovy last week doing us a power hour. Keelan is absolutely top notch. Always well worth having a look out and a listen out for what he's talking around. And he's old school. You notice if you go watch the video, all the photos are. He took them. He's boots on the ground. You'll find that at justonelap.com/power hour. And then we've got another one coming up on the 18th of September, Mishima Gama. We did a sort of introduction, getting started in charting for traders and investors last year. And this year she's taking it to a more advanced level. justonelap.com/events for more information and booking. Shoprite results came out. Disclaimer, I hold Shoprite shares, have done for 20 plus years. And a good set of results. The stock's up some 5%. It had become fairly cheap at around the 260 odd level. It had actually dropped below 250. But what stood out for me was Sixty60. Phenomenal sales growth of 47.7%. That's a big number. But for the first time, they actually gave us a rand value, 18.9 billion. Almost 20 billion. Almost Pick n Pay's market cap. Not fair to Pick n Pay. We're comparing apples with pears, but just wowzer. If we look at Checkers, because it was Checkers Sixty60, Checkers sales is around 100 billion. So it's 20% of that almost. But of course, they've introduced Shoprite Sixty60. There's the Checkers Hypers as well. So there's a lot more to it than just that. But it is a massive, massive number. And it was really strong results. Internal inflation, 2.3%. They're exiting markets that they're not thrilled with, and that's happening a whole bunch. They just other markets in the rest of the continent, furniture and the like, exiting all of those, just saying these no longer meet what we're looking for. And then we had vehicle sales, and I've been harping on around vehicle sales for much of this year because they really have been ticking higher. So we had vehicle sales out on Monday, and August saw 51,880 units. That's up 18.7% from a year ago. It's also the highest level since October 2019. Motors results came out on Tuesday morning. Not a bad set of numbers, but of course that's to year-end June, so not quite all in there. But we are seeing vehicle sales. Question then, what sales? Well, it's Toyota top of the pile with over 13,000 sales. Second is Suzuki. It's about 6.5. CMH, I hold CMH. I have got a lot of Suzuki brands. Volkswagen, Hyundai, Ford, GWM, Great Wall Motors, which is China. Chery, which is China. Isuzu, Kia, Renault, Mahindra, which is India. BMW, Omodo, and Jayco, which did just over 1,200. Nissan and J-Tour, which has done 773, make up the top 15 brands there. And we're not just seeing the fact that sales are improving. What we're seeing is that a lot of those sales are going towards the Chinese brand. And just and it's totally anecdotal. Let's be 100% clear about that. But I live in an apartment block of 226 apartments. When I moved in here 2 years ago, I never saw any of these Chinese brands at all. I don't think I'd seen one at all. Now they are creeping everywhere. There's a couple of Mahindras that have popped up. We're suddenly just seeing all over the place. We're starting to see the Chinese brands come through. And we get it. I spoke about the CX-5 or 3 a couple of weeks ago, which I'd never seen before, but which looked like a really excellent car for 330,000. So what we have is, as I said, highest level since October 2019. I keep on wanting to go back to the 90s. And the stocks are starting to respond. We've got CMH has been moving higher and certainly looking a little bit better after some pressure that they saw, particularly earlier in the year during the tariffs. They're kind of back at the levels from October of last year. Motus had a fairly tough time, although has also been running fairly hard as of now, and rallied quite well off those Liberation Day tariff lows of just over 70, now trading at about 105. It's having a good Tuesday. These are delayed prices, but a ways off the October levels of 125. But, is it the South African consumer is booming? No, not at all. No, let's not even, that's not the story. The story is quite simple. I think the story is that the Chinese cars are cheap and people can afford. We're keeping cars longer, and that means that pent-up demand starts to come, and you can start to see some value in vehicles. I drove in a friend's BMW. It's 14 years old. It was a spectacularly lovely car, but that thing's $1.5 million new, man. $1.5 million. That is insane numbers, and I think for far too many people, just numbers that just aren't viable. So ASP Isotopes listed on the JSE this last week, Wednesday. And so ASP Isotopes is here to take over Renogen, 0.091, I think 9196 ASP Isotopes shares per Renogen share. And it's trading at 1,100 Rand on the JSE, which makes absolutely zero sense. If we get a quick look at what ASP has closed in on the NASDAQ, last close for ASP was 928. Let me get a quick calculator and multiply that by 1770. Call that our Rand dollar. Gives you 164 Rand. Why is it trading at 1,100? I have no idea. I know who the sellers are, because if you just sell here, I mean, absolutely. If I had some ASP Isotope shares, I would sell them in a second. This is not going to hold when the Renogen deal happens. I chatted with CEO Paul Mann. He says he still expects that to conclude by the end of September. I mean, it looks dodgy, and it's usually very few shares. We had 727 shares on the 27th. 255 on the 28th, 10 on the 29th, and then on Monday, yesterday we had 108 shares. It's not volume going through, but don't look at that price and think that that's a real price. That is not even close to the real price. The real price of AC Isotopes is around 165, depending on what price point you're using. Not that absolutely crazy one that we're getting right now. A quick last thought before I end the webcast today. So there was a summit. That was the word I've been looking for. I kept on wanting to call it a conference. There was a summit over the weekend in China. It was India. It was Russia. It was China and a whole bunch of others. India's PM Modi said, excellent meeting with Putin, discussed ways to deepen bilateral cooperations in all sectors, including tariff, fertilizers, space, security. Exchange views with Putin on peaceful resolution of conflict in Ukraine. The point is, this is the new world order taking shape. It absolutely is. And I've been saying it since 21st of January when Trump took over. He is tearing up things left, right, and center. He's leaving the likes of Europe just left slack-jawed, not sure quite what's happening. And what we're seeing is Europe trying to respond. We can debate how well they are or aren't doing that, but the rest of the world, and I mean, this is India, Russia, China. That's kind of much of the BRICS. Only really missing is Brazil and, well, ourselves. But this is the new world order. They're trading oil. They're settling in renminbi rather than in dollars. This is the move. Is it going to overthrow the US anytime soon? No, absolutely not. Is the dollar's power going to fade anytime soon? No, absolutely not. But there will be a point in time in the future when you'll look back and you'll say, when did America catapult its way down from being the superpower, geopolitical as much as economic, and geopolitically, well, 2025 is that year. Make no mistake about that. Worldwide markets, powered by Standard Bank Global Markets, Retail, and Shyft, the global money app that puts travel, shopping, payments, and investments in the palm of your hand. Enjoy the cheapest Forex rates anytime, anywhere. Shyft, powered by Standard Bank. Thanks to Shyft, thanks to Standard Bank for sponsoring the show. We'll leave this week there. Next week, we're going to be late with releasing the video. I'm at LeaderX all day on Tuesday, so I'll only record on Wednesday morning. If you're at LeaderX, come along and say hi. I got a couple of sessions, but I'll be there the whole day. So until next week, my name is Simon. As always, look after yourself, and if you can, look after somebody else as well. Cheers all.